Good evening, everyone. Welcome on board. Cap A checking in, sound check. You put a two if you can't hear me. Firstly, I'd like to thanks everyone for joining us tonight. It's a very cool night today. Definitely conducive for a mind-blowing webinar that is gonna be presented by Peter, our head of research, followed by the survival tips in the world of leverage by our Warren Screen, Isabel, later. Now that we are start, I shall briefly bring you guys through to the few different markets in terms of technical chart for Dow, Hong Kong, Malaysia, and also Singapore. And before I start, right, do read the disclaimer here. And three of us are all licensed by SC. Peter and myself is licensed under the advisory license, while Isabel is under the dealing license. Loud and clear. Thank you, Alex. That's it. For those that have questions, you can actually put in a chat box. We shall look into it later when we are heading towards the Q&A. But without further ado, let me start rolling. These are awards that we have won for this year, and also admit those that are coming in late. And yes, Dow Jones. I think I started off the week on our weekly session in the morning, Monday morning, highlighting that Dow Jones will still be a bit more volatile in the context, and in the event that it breaks through the 4575 level, it's gonna be a bit dangerous. But looking at it is the rebound has been kind of relieving, but it's still not encouraging at this stage. It needs to breach through 46738 level to be a bit safer on that in that context. And we shall see if it can push through tonight. Future seems to be slightly positive. I've not updated myself on like just a minute ago. I have not checked the futures, but yeah, you can always put it in the chat box if you do. Why? Because we are building a very good community here, and you're part of it. Hang Seng has seen a bit steeper impact in the sense, but now as we review the impact of the tariff spat between US and China, is looking to hold around above 25744 level. It's trying to hold on this, and if it can hold itself well, the rebound will be quite encouraging. In terms of Straits Times Index, which is our Singapore counterpart, the setup is still pretty much quite healthy. I would expect it to come slightly lower, but not hitting the 4273 level. But I'll need for a Q of the stochastic to actually flat out before it continue its rally upwards. So I will watch and see for a bit while the retracement is happening. FBM KLCI, nonetheless, I think we have seen this cycle coming here in terms of the oscillator is trying to flat out, or the selling force is actually waning out. This setup is particularly very good. Is trying to surpass the 1617 level again, and if that happens on the technical front, it's gonna break through. And tonight we can also explore with take the opportunity to explore with Peter if there is a potential upside to this range here. And before I pass the floor to Peter, we are still running our campaign Wake Up to Go for our dormant clients. And if you know some of your friends or even your clients that are dormant, this is a good chance to grab some gold. It's at 4,002 now. It's a really, really good deal. And while we are in the market where the strength is quite good, we do have a DF stretch campaign going on. The fee is 0.2 and an interest rate of 6.8 per annum. It's good for you to breach a short-term trade. So you have 7 days before you need to settle it or close the position. This myself, riding every market trend by your side. This me in just it's in Himalaya, but yeah, this is a registration link, but I can actually share it in the chat later. KDI, I put my I just got my salary. I just moved some in again. as a force saving just to max out the 4%. And yes, I always love the last slide. Beware the investment activity that produces applauses. The great move are usually greeted by yawns. Sometimes the boring move do yield more result. And without further ado, I shall pass the floor to Peter. Let's welcome Peter with a clap, guys. Thank you.
Thank you, Captain A, and good evening. Very happy to see so many friends back for this outlook. As usual, my style is to share some of the touch points that we have with our institutional clients, some of our foreign clients, and obviously, goes without saying, we will also share how the corporates are thinking. It's been a jittery season. Things are getting slightly better, right? CI is holding quite nicely above the 1600. So I think without further ado, let's jump into it, right? Tonight's sharing, I will try to go through generally in three phases. Before I go into some of the selected sectors, and I will try to cover up those areas that we have had the majority of discussions, especially with our insti clients as well as our retail clients. I think maybe I'll start off with a quick view on the budget, and then after that, I will go into how we look at things globally in the context for Malaysia, and then after that, we look consider how we think about the external sector. When we think about the external sector, the big shout that Kenanga hopes to be in front of the crowd and also ahead of the curve is our tech upgrade. Um, but it's really are things really that rosy outside? I think generally it does feel like a lot of it is uh, 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 markets going up because of valuations. So we are also trying to have a strategy whereby when we think about our externally exposed sectors, we want to be able to protect the downside that we have recovered so far, but at the same time allow from some upside to go up. So that's how we will be thinking from the external sectors. Now, after the external discussions, we will look internally, right? So I think the big shout over here is we believe currently the market wants to chase consumer. We think it is going to be a nice trade. We are mildly positive from what we saw in the budget as well. But fundamentally, there's more and more data points that are coming up right now that really challenge how we should think about the health of the consumer in general. I'll go into some data points later that suggest generally the consumption levels are not that strong and the appetite is not that great if it wasn't for a lot of handouts and assistances. So in that frame of mind, we do then think differently about how we used to consider, even for the example in the property sector, we have in the past said that we like the mass and the affordable play. We now have shifted away from that, and we have moved into the higher end and higher value developments, for example. Uh, Autos and construction, we still cruise along, but the bigger question nowadays that we get is how much on construction do they want to place their chips in? Because at this juncture, is it possible for a sector to continually outperform for more than 2 years, right? So questions like this I will address. Of course, one of the things that is probably in focus into next year is the elections in Sarawak. So I will also broadly touch on some of the things that we can look at. And finally, just one comment here on carbon tax. It is something that was going to be announced with some level of detail in this parliament sitting, uh, i.e., after budget and up to maybe early December. But we know right now that that is a can that's been kicked down the road. We probably won't hear it until the end of the year. It's not a net positive, and we have to think about it as we move into 2026. Um, I think before I even go into all the thesis, I think it makes sense for me to just pause and allow some of the investors and to understand generally how things flow. In the big shouts that we have in this sector, there are four that we like. RE is one sector that we have been really banging the table on, and it's still something that we think there will be legs to go. Tech is our new upgrade, and banks was a sector that underperformed in the third quarter, in that it was a rate cut in July that caused some concern over there. But generally, moving into fourth quarter, it should perform, and I shall explain why. So, and construction is another sector that we think that there are legs to go. Well, in our key picks, I think generally, how do how does Kenanga differ from the rest of our competitors? I think we do have PCAM, for example, within our stock recommendations, but that's not to be seen in isolation, because within our portfolio, I think we are still relatively balanced. We have dividend growth stocks in our portfolio, Bank, Hong Leong Bank, and also Timecom, which pays a very good yield. And of course, on the small cap side, Solavest and Samaden are the ones that we are looking at quite with a lot of interest, and KJTS being the other name that we are also promoting. Wasco is the one that I think we are seeing quite a good recovery, given their intention to IPO their green energy business, and that spin-off potential could be another value unlocking as well. And Duo Pharma, I think we know that this is because of the focus in generic healthcare drugs, for example. Yeah, having said all that, towards the year end, I am for once not very bullish, I would say. I would think on the CI is 1640, which only means about 2% upside from here. But does it mean that there are no stock plays? Of course not, because KLCI only focus on the top 30 stocks. The dynamics at the bigger stocks area don't always translate into the non into the other spaces. So, for example, certain areas like tech and renewable energies, they are not represented there, and we do believe that there's definitely opportunities. Okay, I think back to the quick comment on the budget. I would be unbiased if I use historical data to show you that this chart that looks like a spider shows that most of the time, in fact, two-thirds of the time after the budget and one calendar month after that, the market is generally lower. Uh, or flat. So this creates a situation where there are some trading opportunities. In my report, I put out, I call it not big ticket, but big ideas. We have a lot of spending right now in AI that was absent in the previous budget. So in this space, investors can look at names like Gamuda, or even to some extent YTL Power. The former because of their uh, desire to provide sovereign AI cloud, which we heard Prime Minister Anwar talk about, and also because the entire focus and the push for AI is very holistic, all the way from policy to SME support. That will also improve the incentive and incentivize those that have on the application layer of AI, including GPU as a service, including LLM, and that's actually under YTL, for example. But for the broader market, sorry, before that, we also think autos, RE, utilities, and water are the other big ideas. Well, on the broader market, how we see it is that calling a spade, actually the development expenditure wasn't up to consensus expectation, which was about 86 billion. It came in at 81 billion as an estimate for 2026. So this is a little bit of a dampener, but of course, I was also on air the other day on BFM to to actually mention that markets will take a more balanced view in that we will consider the fact that there were no real new taxes, right? No negative surprises, and on top of that, our government budget and trajectory for fiscal consolidation is actually quite good, given that we are not over reliant on oil and gas in our budget, right? We are only projecting about 20 billion oil and gas revenue dividends from Petronas, for example. So I think all considered, it is not a negative. It's just not very exciting. So we think there is chance for us to take some profits. Now, of course, where we differ is I think some of the other brokers do think that consumer is a great play. That's where we slightly differ. If we look at it from a year-on-year perspective, and you count your STR and SARA programs, and if you add them out, all the cash assistances, it's about 15 billion. And actually, that's just same as last year. So there is no incremental or delta from here. And therefore, I think that's where we resist chasing as well. So some of the names where we are positive on are below here, but never mind. As we go along, I will also explain a little bit more. Now, how Malaysia fits in the cycle. These are charts of generally the ASEAN markets as well as S&P 500. There was improvement in the third quarter generally for ASEAN markets, including Malaysia. But one thing more importantly to note is that whilst there was improvement, there was no foreign inflow. In fact, it was foreign outflow in the markets. So we are in an environment whereby in October we did see some improvement month to date in Malaysia in the second column, but usually during the budget month for the past 4 years, it has always been foreign participation increase rather than retail participation. So the tide has sort of turned in that sense. Now, am I completely surprised at what we are seeing in terms of DMs doing well, the developed markets, and for ASEAN to slightly underperform? Actually, also no, because when we look at the times when the US cut rates into cutting into weakness under an environment that wasn't going into recession, what we tended to see was the S&P 500 in a 12-month basis always was positive, and ASEAN, the one that I boxed up, tended to underperform for a bit. So we are still waiting. We are still waiting. Hopefully, the ringgit strengthening, and we expect 408 by this year end and 3.95 for next year end will continue to draw in the foreign investors. However, because of the pace and the speed of the improvement is not drastic. It's more gradual. We think that the inflow into the this part of the world, especially Malaysia, will also be more gradual. What would be the key standout for Malaysia then? So on the left, you would see that that is the dividends, including forex gains. If we look at the strength of our budget, and then we look at what the consensus is looking for in terms of currency appreciation potential, actually Malaysia currently offers dividend yields that is almost at par with Indonesia, neck to neck. So that's where we stand. We have and that is where we believe there continues to be a lot of interest, especially because if you just look at valuations on the right, the where the triangle is the current valuations and versus historical and versus the other countries. We're not exactly that cheap. So while we think that there will be inflow, it will be more gradual. And number two, the interest right now still seems to be a little bit more on the dividends type of space versus the more growthy type of space. I think I'll just move on faster and skip some of these slides. I think generally when we look at the after a rate cut in Malaysia, this is a relative returns graph. What it is trying to tell us is if which are the sectors that tended to do better than the general market, and which are the ones that tended to do worse. The line on the bottom is the one that maybe is a better gauge, which is an average of the earlier few times, and that's why we have conviction that on a 12 months basis, since our July rate cut, that's where we can look at banks to perform better. That's one of the thesis that we are looking for. Furthermore, I think for banks, for those who look for at bigger stocks, we think that it offers the best risk reward for dividends. Last quarter, we would have said it's telco, but after the rate cut, we think it's back to banks, and we can explain why. Yep, I think generally we think that right now we think that there is some broadening out. When we mean broadening out, we mean that there is more interest in the smaller cap space. But to be honest, just looking at this chart is a little bit more complex. But essentially, the one that is red line represents the uh, valuation difference between big cap and small cap. Right now, that valuation difference, whenever the difference is large, that means the small cap is cheap, right? So people will buy. When the difference is small, that means valuations between big cap and small cap is not really very different, right? So if we use this type of mechanics to approach when it small, bullish for small cap, when is it bearish for small cap, we can work out some sort of correlation. And then right now, actually, we are somewhat in the middle. That means we cannot really be overly bullish everywhere, but we have to be very careful because earnings growth is what people will look for the next run up. And that's why I'm here to tell you in 2026, these are the names that we think that there's more than 10% upside and also earnings growth moving into 2026. How we read this chart is that for the same level of valuations, any of the stocks towards the right is more superior, right? Because you got more earnings growth for the same level of valuations. And for that, we have names like Semaiden, Tongguan, which is one of the plastics name, the only plastics name that we like right now, LBS Bena, which we have recently initiated on, Wasco, as I mentioned, and Encom as well, which may have catalysts. So these are some of the names that we consider, better risk reward. I will spend not much time here. I would say that what we are trying to do is to have the word here is a buzzword, but it's actually a protective put. It means we are trying to protect our downside, and then at the same time we let our upside run, right? So in doing that, we can use the same thinking and we apply to oil and gas, and we apply to even plantations. So if you look at the graph below here, it's just showing dialogue and also PCAM. If you can see over here, during times when the market is bad, dialogue typically have more insulated to the downside because of their storage business. If there's a lot of oil out there and they need to be stored instead of being consumed, that could offer some downside. And PCAM, whenever the economy is doing well, it will go up. So I think what we are thinking or trying to help us to think is to think about it as a pair or a grouping so that it helps give us some exposure. We won't lose out if the market runs, but at the same time, if the market comes off, we are more protected. We use the same. In fact, this is also what we tell our INSEE fund managers. We can think about the same construction for this KLK and Hap Seng plant. For example, for Hap Seng plant, which we know is more upstream and always give you the good upside. This is balanced against KLK, which is more integrated, and you can see from the graph that when the black line, which is the CPO price drops, their tendency is for KLK to be more small in magnitude of movement. And then, of course, that is basically how we think about it. Okay, just spend a few more minutes on some of the thematics that we see. I mentioned earlier that in the consumer space, we have a change of mind on how we look at consumer. Historically, we like all those mass and affordable, but if you look at some of the indication and data coming up, actually, it's not really that healthy. The top graph is actually the residential overhang, and the green line is the one that is most telling because you must look at the green line being the 300,000 ringgit houses, that is inching up very fast. And then if you look at the bottom, if you look at wages real wages, meaning to say wages minus inflation. Actually, for the private wages, it has been no growth over the past 5 years. Oops, right? So that is something that we take into consideration. And in that environment, we are just a little bit more cautious on saying that consumer is sustainably bullish. We are neutral, which means we should buy some of those stocks, but we do think that sometimes it would be more wise to trade those stocks. Yeah, I think the teams in Sarawak, I won't go into each of these teams specifically, but I think generally some of these names we don't have under coverage, but we just put over here to give you a flavor. Those that are in the more state election sort of theme, which we also identify is in the fourth column. One of the names that we highlight would be Insight in Analytics. In fact, our analyst Sinket recently wrote an IPO note. We believe that this stock should be fair valued at 88 cent, and that looks like a huge jump from the IPO subscription price because we believe this stock over time they will look at it less and less as a industrial and water play, but more and more as a software and tech play. So that's why we look at it differently. Otherwise, names that we get asked quite frequently by institute investors would be Ibraco, who is well represented across several verticals, and also Pansa. Pansa and Ibraco, I think one of the emerging themes that they are able to latch on is water infrastructure. So those who speak or follow Ibraco will know that they have invested into a pipes facility, and Pansa themselves are looking at water treatment opportunities. Yeah, I think that is just a roundup of some of the key thematics. I'll just flash this chart so that it gets into the YouTube, gets and to show what were our recommendations and target prices. It could be slightly a few days late. I apologize for that. And this is also our econs expectation. I really won't go into much into econs. I'll just spend 1 minute to talk about it. We think that this year, moving into next year, the GDP will come up by zero point 0.1 percentage points to 4.2% next year. So we also believe that the fiscal consolidation is largely on track. Although we are less bullish than government's own 3.5%, we have it at 3.7%. All in, what we are saying, right? So many numbers. We are saying that the economy is doing really well, but we don't see anything really transformative at this moment. So we think what will help us a lot is the ringgit sort of strengthening, and we believe this is going to end at 4.08 this year, which is still not as aggressive as our Bank Negara, who is saying that we should be able to touch 4. Okay, I got about 15 to 20 minutes left. I'm aware. So I would like to take us through some of our views on the sectors that we like, right? So I mentioned we have only just upgraded technology, and therefore I would start from there, which is our big shout. I think after we have upgraded the technology sector just quite recently, I think the market has reacted positively to this as well. But fundamentally, it is supported because there is a very encouraging time series on semiconductor sales, which continue to surge past 22 months, which is relatively bullish in terms of year-and-year growth. And that momentum continuing will show that this is a very firm cycle into the capex. And also, what we are seeing is the global fab equipment spending, as you can see from the left side, bottom left, that is showing a quite positive trajectory. I think that then dovetails with the chart on the top right. The chart on the top right is saying that the worldwide vehicle sales are doing relatively well, moving up from a low base. And what we are saying is because there is going to be more focus on EV. So EVs content of LEDs and semiconductors is easily 2 or 3 times non-EVs. So that sort of focus now shines the spotlight back into some of the auto-focus players like MPI and DNO. Overall, I think for the benefit of investors, this slide may be useful for you if you are following some of these names. We are not now positive on EMS for the reasons mentioned in this table. There is still some ongoing negotiations about sharing costs in some customers, but some customers, for some of these companies, say it can be completely passed through. So what we mean to say is that it is blurred, right? Some are positive, some are mixed. Whereas the rest, I'll just leave it for you to take a look. And right now, just to round it up, we like Kellington and UWC. Given their front end leverage, I think Kellington generally it has surprised in terms of valuation re-rating. The even institutional investors, some of them are a bit light and they continue to chase. I think the reason here is quite simple. They managed to break into new territories, right? Rather than their old legacy countries, they managed to go into Europe, for example. So they are being rewarded with a higher valuation now. I think for UWC, as you can see here, our target price has been exceeded. I believe I'm getting my analyst to, of course, to relook. There are certain positives that we are still studying, which could confer more significantly upside from our TP right now. I would say that, of course, that we will have to assess once we have clarity, especially right now after the share price come up. We do believe some of the front end items are quite well priced in, but some of the back end potential that UWC is doing could still confer some upside, as well as if in a more bullish scenario, even Intel, which used to contribute 30% to UWC and now roughly about 10%, there could be some upside if Intel gets its act together. And of course, Inari is a valuation upgrade. Okay, so hope that was useful, and then I welcome questions later. On the renewable energy, I don't think we have significantly changed our view. We still believe at this juncture that the market pie is a growing one, especially with the announcement of LSS6 into 2026, and also CRES, which is the program that allows the data centers and hyperscalers to now adopt renewable energy at a palatable rate. This now is pushing the market much stronger into 2026. So when we see a pie that is growing, we buy what? We buy the things that are going to get market share, right? So that's the easiest way to think about it. So in this space, SolarVest is our solidly top pick right here. My TP is 3.56, which I now I cover myself. But the full benefit, if we give it for its EPCC, Blue Sky fair value should be 4 ringgit and 60 cents. Now, why so much, right? This is because under its JV, if you have been following, there is this Brookfield Fund, which is coming in to help fund 1.5 gigawatt under CREST. So that means your data centers who want to take few hundred gigawatt, few hundred megawatt can immediately go under CREST, and then SolarVest will be able to do the EPCC, for example. But these are very lumpy. So when it's very lumpy, it's very hard for me to put pinpoint. But if we think that if you give a full year benefit of EPCC, maybe in FY28, for example, and we slap it on the current valuations, we should get to that figure that I mentioned. So Maiden is just more of a conviction call that we have in this quarter, because most of the institutional fund managers are neglected, right? They have been chasing the others, and we are seeing some of the valuation catch up. And at this moment, moment, we are neutral on Pekat, for example. There is some questions we always get from the Insti side on solar module prices, but we are glad to inform that players like SolarVest and Maiden have secured 1 to 2 gigawatt type of solar panel in terms of locked-in commercial terms. What this means is that up to LSS 5 plus and even towards LSS 6, they do have already the buffer, so they are not likely to be affected, and therefore we are still very comfortable. Now, I'll just quickly speak on banks. I'm not very sure whether there's a lot of interest in banks, but I'll just mention what is the upside from here. We know that when there's a rate cut, there's always a NIM compression, and that will impact banks by about 2% earnings. But because this year there is the Ventris or previously Sapura Energy, they have sorted themselves out with the banks now owning some of these shares. If whatever they have previously in terms of exposure as a bond, we believe that there is a chance for them to actually write back some of these provisions. So if it does happen, it should negate the impact of the interest rate cut. We also think currently the moving into the later part of the year and into 2026, if we don't think that GDP growth is going to be that strong, then we prefer banks that are able to deliver on growth and not reliant on public spending, like your Hong Leong Bank and M Bank, which M Bank is also not chasing for market share, right? So we like banks that probably won't disappoint you on growth, is what we are saying. The last quarter, we would have CIMB here, but because CIMB has re-rated more than 10%, 15%, we think it's time to take it off our market picks. Everyone's favorite topic, data centers, right? So we move into construction very quickly. In construction, the thinking is quite simple. We think as Kenanga, 22 times PER is what we are willing to pay. Anything more than that, we think it is excessive, to be honest. So the way we think about it is from here, why 22 times? Because it is 10% higher than the valuations we saw during last peak. So the previous peak, when the market awards, as you see on the top left, was about 180, 160 billion. The previous peak, we saw that the valuations was about 20 times. So now that the market total awards is about 180, 190 billion, we think 22 times is fair. So for that reason, we think as we move into the next year, you can see the analyst expectation about order book replenishment. The ones that I need to point out is Suncon and IJM. The majority of their books, in terms of what they are targeting, would be considered data center related. So for that reason, we think as we move further ahead, the one that is lesser and lesser dependent on data center may be the right way to go, and therefore we still like Gamuda, which is more diversified, and you can see the order book increase in terms of a year-on-year expectation. On the smaller cap side, we like Kim Lun. That is a name that we do like at this moment. I'll go through some of the other within the next 10 minutes. Adrian, I'll go through some of the other frequently asked sectors, I would say. So I think in terms of property, as I mentioned, we like the higher valued ones now. Previously, we would have been pushing Mars Singh, but we think right now we are pushing more on the SP Setia and Signprop. We do think at this juncture, Sunway Berhad remains relatively expensive. Even if we give what market wants for Sunway Healthcare Group, we think currently it's also priced in our opinion. So for that reason, we are not going to ask investors to chase Sunway Berhad. At the moment, we still like Masing in terms of having a positive rec, but we have relegated it behind because we think we are monitoring their delivery on their data center efforts, which I think is starting to slow down a bit. So for that reason, the analysts have also looked at it more carefully in terms of what valuation expressed as a RN, what we like to call a discount to the book value or RNAV, right? I think having gone through property, just a few more things to call out. I think healthcare is one area that because of Sunway Healthcare Group, I'm sure there's a lot more interest analyst. Currently, our analyst who looks at healthcare recently downgraded IHH at a target price of 850. We are neutral. I think what we are saying is there has been about 18% share price rise since the Sunway Healthcare draft prospectus. If you recall, this somewhat of a Westports also saw about 18-20% share price rise when people were talking about MMC IPO. So we think firstly for every 1% change in valuation, and over here we like to use this metric called EV EBITDA. So when this EV EBITDA increase generally by 1 percentage points, that should help us gain about 3 to 5 to 8% in terms of share price for IHH and KPJ. The way we think about it is because KPJ's valuation is still relatively cheaper than IHH. We think at this moment IHH seems the lesser of the two in terms of valuation re-rating potential. And for those reasons, I think we have gone a bit light on healthcare. Well, gloves, we think currently gloves, we do think in the most recent quarter, we all know that Top Glove actually had met their volume growth guidance, reversing several quarters of disappointment in that trajectory. So moving on from here, what we believe is that currently the market still want to validate in terms of the trajectory. So we think that those that can deliver good numbers and reliable like Kosan is the better play overall. Okay, I think other than that, more on the local side, the other area that we do get asked is autos. Autos is an interesting one because if those who follow will know, right, that if you want to buy a EV car, fast buy this year because next year some of the imported CBU EV incentives will no longer be enjoyed, and we think that that would actually benefit the locals, especially those like Proton and Produa who will be likely launching their EV variant soon, and those will likely shift the focus from imported CBU units to the more competitive local ones. So for that reason, we still like MBMR, and of course the two-wheeler Hong Leong Industries is also something that we like. Questions that we get a lot is Burmas Auto, B Auto. Our analyst thinks that whilst the worst is over, the difficulty here is the gestation period could still be very long because of the pipeline of vehicles that are coming in, especially with the CX5 model probably later by more than 12 months from here. So I think the actual excitement into new units and earnings growth probably is more delayed. If we put in money now, the waiting period could be quite long. So I think for that reason, we are not yet pushing B Auto for that reason. One of the areas that we constantly discuss, even on this call, is oil and gas. Right now, where we are in the oil and gas cycle, we are no longer as bullish in the upstream services sector. We think the third quarter earnings, there could be still the banana skin in some of these names in terms of earnings disappointment. So we don't want to do that now. But we think Dialog is a good pick, and PCAM is the other one that if pairing them together will be the best way to look at this area. And of course, Wasco, which we have highlighted earlier. Finally, I'll end with plantation. So plantation, as I mentioned in my earlier slide, we like KLK for it being integrated. We like Housing Plant. Housing Plant is one of those names that even on a normal basis, they have about one-third of its net assets is in cash, a dividend yield of more than 5%. So even if there was some downside, we think that it will not be very significant. This is one sector that can go both ways, and that's why we say it that way. For example, moving into up to 9 months, the CPO price was 4350. Moving to next year, other non-palm oils are going to increase in supply. So overall, total oil market prices should come off a little bit, but the upside is here could be in Indonesia, where if the government is serious about B50 blending in their diesel, that could provide another jolt as well. So we want to make sure we're able to take advantage on the upside while also protecting our downside. And finally, PPB, we think the worst is over. Some of the worst news on governance and also their being the litigation in Indonesia has been quite well understood and quite absorbed into the price. We believe this is now where investors can start to look into this name as well. So yeah, I think I have been going on for the past 40 over minutes, and I thank you for your patience. I'll hand it back to Adrian for any Q&A. Yeah.
Oh, thank you, Peter. I must I must say the thought of doing a pair trade within the sector is definitely an angle that not many have shared in the market,
Mhm.
especially on creating a synthetic alpha for that. Do not mind my I mean my jargons are just trying to sound sophisticated. Basically, you're trying to lock in a spread, right?
Yes, thank you, Captain. Yes, thank you for making it even more sophisticated than I have already made it. Yes.
Okay, and I think over the when we must also I must say that in the oil and gas scene, Syncat's pick has performed relatively well and quietly on dialogue, and seems like it's still got some legs. Kudos to them. But as I think when we look back, I have some questions, and before I move to my questions, right? For those that are in the crowd, do not feel shy. Do type your burning questions in the chat box, like here. I'm just saying a hi there. But yeah, there are a lot of questions that I wanted to ask, but let's see where should we start. Sarawak, let's per se. Um, Insight Analytics will be going for a listing on the 27th of October, and the listing price is actually 36 cent.
Yeah.
Looking at the perspective of so going through some of the market report, how do we can you share with us on a thought where how do we view it differently as compared to the market?
Yeah, I absolutely can, absolutely can. I think Insight Analytics is for those who are not that familiar yet, essentially has got two business models, I would say. So there is a water part of the business, which is the older business, and right now in the newer business, sort of like a tech platform business, which is both used in government and private enterprise. That is going to be the growth area. We foresee that over the growth area of this tech, which garners a margin of about 70 over percent, is also going to be the larger business contributor. So if you think about it, this is using tech, AI, and analytics for your water business, and what this means is that this business can be scalable very fast. So it's
Hmm.
also a faster growth area, and I think given that they are able to monetize this sort of platform and software, and this is going to be a significantly large area. We think it is a disservice to the company to just call it an industrials company, and some of the other houses will just put in an industrials valuation, lah, like 11, 12 times,
Hmm.
right? So I think generally the way we look at it differently is to give some benefit to the valuation, a larger portion towards a more like a software type of 20 times level of valuation, and then the water business, which is more legacy, we put it in the teens. So blended is about we go with a 20 times around valuation, and therefore our target price is slightly above 80 cent. So I think that's how we differ, and we probably I think right now still one of the highest in the market. It completely because it's how we think about the company. Yeah.
That is definitely a perspective. I guess the market might have just missed. Well, they are a bit too engrossed in the water sector, right?
It's possible. It's possible. Yeah.
Hmm. All
I
right.
think yeah that is our view on Insight Analytics IPO. That's right.
Okay, before I hop on my own personal questions, let me turn to the floor where one from Wilson. Uh,
Sure.
Wilson L. What is the top sector and share name that might have the highest growth potential in 2026?
Okay. Okay. Right. Right. Top sector and growth potential, right? We are talking about
Yep.
if we are talking about the growth, I assume here we are talking about just organic growth and share price growth. I think at this juncture, we whilst we are highlighting tech quite significantly, we do also expect that tech has got already some re-rating, right? I think it's come out about
Yep.
15 to 20%.
Yep.
So I think some of the easy money has been made tech in that sense. We still like the sector. It's just that if you're asking me to relatively rank the sector, then I would say we have more earnings growth in RE. Now, the way you think about it is the earnings growth is usually quite tied into our PE valuations, right? So let's say we have our solar sector, we still give it 30% growth because we think the earnings growth is going to be at close to 30%, right? So 30 times PE and 30 times earnings growth. So it's kind of balanced in that sense. So even from how we value the company, you can roughly work out what is the earnings growth. I would say renewable energy is the one that we still are quite positive on, and probably still confers the upside moving into 2026. As a short answer to a question by William, is it? Yeah.
Wilson, yeah, correct. While
Wilson,
we
sorry,
are
Wilson.
in
Yeah.
the tech sector just now, there's one question from what do you call it? What do you think about front can? Where is it?
Yeah, yeah.
Just went up a
Yeah.
bit.
Yeah, I think Franken is a foreign favorite. So when the foreigners did come in earlier this, I would say earlier this month or late last month, and we did see certain buying into Penta. We saw buying into
Ah,
Franken, for example. So some of the ATE names are definitely as well that they nibbled into. I think that sort of momentum, in my opinion, has sort of come off a little bit, where foreigners select what they like. Of course, Franken is also somewhat of a top-down play, lah, right? We know the company does have it's an easy leverage towards TSMC, for example. So I think generally that would be an area that is also, in my opinion, would have fit our thesis had Kenanga have the coverage over it. We would like that space and also that leverage to that growth area. How as you can see in our picks, some of Killington, you would see more front end type of thing. But at this moment, I am unable to share you a view because unfortunately we haven't put it on coverage yet.
yeah. Well, the question is circling between power and tech, right? Let me jump to Wilson. What's the outlook for utility sector like Tenaga, Malakoff, and YTL Power? And if
Mm,
I were to add to that question also on my end,
yeah.
it's like tumpang a bit, huh?
Mm.
What do you think about the sub-utility side
Yeah, sure, sure.
where
Yeah,
the
yeah.
the cables,
Power auxiliary. Yeah, power
the
auxiliary,
light in
right?
low, this kind of.
Yeah, yeah, sure. I'll take both questions together. Right. I think at this moment, first of all, let me answer the utility sector first. We are overweight the sector. The names that we like include Malakoff. The names that we like include Tenaga. Tenaga has been our top sector pick. And I'll talk about YTL shortly. But for Tenaga, I think generally in all our meetings with the Insti, there will always be a question on our view on the tax for the company, right? We all know that the taxman has come to knock on the door. One of the simpler ways for us to maybe put our mind around this is that if we just strip away the tax issues, generally there's nothing much that we need to be worried about the company right now. In fact, the continued growth in the data center space and the demand will continue to make their generation side more efficient, and they could have kept more profits there. So I think currently the way we think about it is, if you hold Tenaga, it is you should continue to hold it in that the drop in the Tenaga share price is already factored in the entirety of the tax bill already in terms of market cap. So I think in that sense, we are very confident at this juncture that Tenaga, the risk reward is only positive. For Malakoff, I think we know in the market that the Energy Commission have put out certain tenders for power plants. We believe, given the amount of power that needs to be built up, there's enough to go around. So meaning to say that the likes of Malakoff, YTL, and all that all stand a very good chance. We have included a one potential power plant into our estimates for
Mm,
Malakoff already, and
okay.
therefore for that reason, our Malakoff share price target price is high. So we also know that this Malakoff is one of those stocks that they are never really how to say commendable for execution now, right? Meaning to say earnings here and there sometimes there will be disappointment and surprises. We think that for earnings to actually improve is not the play here because that will have to wait until the power plant is constructed. I think what we are saying is they don't look for it as earnings delivery. Look at Malakoff as a proper possible winner beneficiary play lah. So I think what I really am saying is we don't look at it more on the earnings angle lah. I think another stock that probably is looking at it from an earnings angle of YTL Power. Definitely, your question on YTL Power I would like to answer in my discussions with the Insti side. Things have quieted down a bit. I think right now the market roughly know that on their AI side, some of the businesses where previously they were going to go into AI and the DC, now they are moving into colo, right? They have converted some to co-location. So I think generally it's still a little bit more wait and see at the AI side and data center side of things. However, on the YTL side, we also note that at this juncture, they are developing new things, right? Like AI and even Rand Hill, for example. Those are certain areas that I don't think is that we should be neglecting lah. We still like the stock at this moment. It's just that we don't think that there's a very immediate catalyst for us to push. So we are just wait and see at the moment and preferring the Naga over YTL at this current prices. Oh yeah,
All right.
Captain A's question, right? So, in terms of Kenanga, we also keep closely in touch with some of the power auxiliary players. I think generally, if you look through our coverage, we don't actually have coverage yet. But I would say, generally, we still have got a lot of interest, even in the am I right to say older power auxiliary players like MN Holdings and also the likes of Southern Cable, for example,
Yep.
continue to have a very good following in our opinion. I think for one, Southern Cable, they, as we know, they have a desire to break into export markets into the US, and for that, the customers are able to absorb their tariffs. So for those reasons, there is no worry about growth. But I think generally in the market, they are also starting to move into other areas within power
Mm,
auxiliary. So for example, investors are also looking at OCK, right? So OCK currently have mentioned that they are trying to IPO their power company, EI Power company, right? So it's called EIPT. So that one is worth looking at if you're looking at asset unlocking into OCK. EIPT does the data centers, and what they do is they are the power backup lah. Imagine you have like a
mm,
power bank for your data center in case
yep.
there's no power, right? So that's one area. And then of course, within the data centers themselves, nowadays the data centers has got a lot of load and IT requirement. You will need a lot of the I would say the contractors that are specializing in the requirements for a data center, which could be very different from a building, for example. So some of these names like Powerwell and all that, we also get asked, although it's less discovered at this moment.
All right. I'm
Mm.
taking note now, Peter, on the
Yeah, yeah,
names.
yeah, 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 yeah. Just giving some feedback as to like some of the names that Insti are looking at. And apologies, Captain, because we haven't got official coverage. But please give me some time. We definitely need to look into that. Yeah.
No worries. We are always on the hunt for new discoveries and gems, right? But
Mm.
let me move into Adrian, Yvonne, and Angela's question. I always like Adrian, Yvonne, and Angela because it's a representing of, if I recall, his family. Will e-invoicing companies benefit from the budget which government says all invoicing initiative will be starting in 2026 or in Adrian's word, fully implemented?
Yeah. I think the e-invoicing angle is something that I believe to be a beneficiary that in that the government is very uh, keen on executing it. And it's definitely one of the ways to prevent leakages. As you can see in the most of the reforms that the government is doing, be it the Budi 95, be it e-invoicing, it's all about the political will to stop leakages. So if you ask me, the government will implement, and the short answer to e-invoicing companies, in my opinion, should be yes, just from a very top-down angle of where the government needs to tighten up, right? So that would be the simple answer, Adrian. Yeah.
Yeah, good. There are some in the Q&A box. And hello, Madam Louis. I saw you the other day during our Singapore lunch talk. And yeah, Madam Louis has two questions since I'm on Madam Louis. I think anything on budget, Peter have highlighted it earlier. So we shall
Mm-hmm.
move it to what extent data centers have addressed clean, renewable energy that will impact
Mm.
relying income from data center.
Oh, do you mean how
How the country has addressed from the angle of renewable energy
data
in
center?
in compared to the power demand from data center,
Oh,
the need.
okay. You're saying how is data center now using green energy? Is it, Adrian? Am I right?
I
Am I?
think Madam Louis' question is along that perspective, and how would it
Mm,
impact those businesses relying incomes from data center?
okay, okay, right, right.
Yeah,
Okay, so I'm guessing she's trying to find out how data centers and their consumption of green
yeah,
energy can be a investable area lah, right? Like how do I make money out of this lah, right? That for data centers
yeah.
to take this right. So I think maybe I just take a step back first to explain how the data centers requirements are. So data centers requirements previously when they first came in, right, government said, okay, I give you green lane, I give you a lot of energy. So just welcoming everyone to come. And at that time, there was actually no carrot and stick lah. You just come only, right? You use
Okay.
energy, you are being inefficient. Also, I don't really care so much. But now because we have come up with our own what we call power, water, and energy carbon utilization efficiency, CUE, PUE, WUE, and all this being some sort of like at least a threshold lah. If you meet this threshold, we will kind of like approve your projects, right? So because
Mm,
now there is more of a check and balance for the new data centers, they want the data centers number one to be more efficient lah. So there is already a thinking that we need to be more green. So number one, awareness and the rules. Number two, previously there was some of these programs that are mostly under CRES, for example, that was already available in the market. But at the time, the system access charge, meaning to say that if let's say the data center wants solar, and then under the CRES program, the solar developer will have to pay certain wheeling charges, i.e., pay for the transmission and distribution to Kenanga at a certain price. That pricing was quite high, and right now, after the whole revamp of the new pricing pricing. Currently, the data centers is at the stage whereby, if I go for this crest pricing and versus I pay the ultra high commercial
Agree.
rate, that is roughly the same already. So the data center suddenly wake up to say, hey, why not for the same price? I just do solar lah, right? So I
Yeah.
think that is why crest demand now is going to be the next wave. We have seen even Tenaga go into it, signing a 700 megawatt MOU for crest with day one data centers. We are also seeing, for example, our top sector pick, Solar Vest, for example, going to try to do 1.5 gig or 5.3 billion ringgit worth of total crest demand. So you can see the demand over here is relatively large. So obviously, this is the more direct way of saying how can we make money when data centers need to adopt more green in their energy. Do they really need to do it? The answer may be no, but in the past there was completely no monetary incentive for them to do that because normal energy would have been cheaper. Yeah.
Yeah. We are now at 9:03 p.m. and we'll be ending the session in 9:30. So we still have some questions to go before we transition to Isabel at
Yeah.
9:15.
Yeah.
So some of the questions from the floor will be the recent hot topic about Genting's privatization, and
Yeah.
one of the first is how do you really view the offer for Genting Malaysia?
Yeah.
Second is from
Yeah.
AK. It will be how do you see Genting in the next 2 years?
Yeah, yeah. That's a thank you for that question. I think on I must be careful to say that at this juncture, I'm sharing some views that is of my own. And I think
Mm.
the reason why I want to say that, Adrian, is because research is under blackout. Right, so
Oh, okay. All right, all right.
Kenanga cannot make Kenanga's view, but since you asked, and just to give your opinion, I think right now, this deal, if you look at the premium that is being offered, it's definitely not very high, right? So
Yeah.
when the premium is definitely not very high, we don't think that this is a deal that Genting Berhad wants or is thinking about taking over or buying over everyone. So, but they probably will be happy to have halfway of success, right?
Oh,
Some people who don't think that Genting Malaysia will win the bid in New York City for the license will probably think that at this price it's a good time to sell. And one of the ways to get a slight premium, that those people will likely sell out lah for 235, right? But
yeah.
I think Genting Berhad is also wise enough to know that the premium is not high, and those people who want to believe that they will get the New York City bid, they will unlikely to accept lah. But the way we think about it is actually quite simple because Genting Berhad owns about 14, if I'm not mistaken, about 49%
49 years.
of Genting Malaysia. One way we think about it is actually more flexibility for Genting Berhad. I mean, my personal view is that Genting Berhad is definitely more worth looking at the moment. Why? Because let's say if Genting Berhad right now manages to so-called buy up more shares, increase their stake to more than 49% at 2 ringgit 35 cent. What may happen after this is, let's say, for example, Genting Malaysia does win the New York license, right? And at that time, they will need funding, lah, the 2 billion US dollar or so.
Yep.
What can Genting Berhad then do is to say that, oh, maybe at the time, if they need funding, Genting Malaysia can then, issue shares, and then Genting Berhad can just allow themselves to be diluted from there, but they enjoy a little bit of a spread lah, right? Maybe at the time Genting Malaysia may be closer to 3 rather than closer to
Yeah.
230, right? So I think it's quite a genius way for Genting Berhad to sort of like retain some flexibility. So right now, what I think is definitely worth a look in is actually looking at the Genting Berhad level lah,
Yeah.
rather than saying Genting Malaysia level, because back to my just simplistic view is that the premium is not that exciting at the Genting Malaysia level.
All right. So there's one question from Vic. Do you all cover CTOS and Topcouple? If yes, what do you think about the fundamentals?
Yeah, okay. I think Citos is a name that we have a 79-cent target price. What by saying that we think the way that we approach the thinking is a very mathematical one. Fundamentally, there is nothing wrong with the business that they are in, but I think what has happened over the course of the past 1.5 years is a silent admission by the management that their initial assumptions of the growth rate of the market is below what it is today. Right, so they have had to reduce their earnings growth potential such that today, in my conversations with most fund managers, while they don't think that there's wrong in the business, investors question what is the right valuation for a business where the growth is now slightly lower. So the way we can think about it is, again, it's a mathematical equation. If the company is growing at about 18 to 20 times, we think that would be so-called the maximum that I will pay for PE lah, right? 20 times earnings. So I pay at most 18 to 20 times
Correct.
PE. So given that thinking, unless the company suddenly finds a new breakout, we think at the 1 ringgit level, it's not really good risk reward in our view. So we will resist to chase the CETOS name lah. Obviously, we all know as well that there is overhang. The CFO has recently left, and they are still in the area of looking for CEO, right? I feel that the market is we're trying to give the company some benefit of the doubt that whoever credor wants to put in there will turn the ship around and accelerate growth. But that's also a hope lah at this moment, and we rather see it and evaluate it than to buy on hope because we think 20 times earnings is probably the reasonable price to go in to give yourself some buffer lah, and don't chase. Yeah.
All right. So how about Takaful?
I think Syarikat Takaful is a name that uh, that we like. I think on the Takaful side, uh, currently there is a lot of talk about DRG and all that. Generally, we already know that the ability for the DRG to be an immediate risk is now kicked down further, right? In 2027, for example. And even if there was a so-called lesser growth in terms of how fast insurance companies can price up their medical.
Yep.
That was one of the questions that came out, I think, for most of this year we've been talking about it lah. So I think generally the market will start to see that there is a way to break from this deadlock. In that
Ah,
we could be able to come out with very basic sort of DRG programs. For those on the call, the DRG is basically a system whereby we itemize the individual items and we have a certain pricing for certain when you go to the hospital or clinic, all the procedures will be priced. And in the past, people were just worried that this is not good for the medical sector, and therefore it cannot be good for insurance as well. But I think moving on from here, in our conversations with those in the discussions of DRG, we think that increasingly we will see very what they call like a more basic model. In when you say a basic model, it means that not
mm,
everything is under DRG. Maybe certain
okay.
illnesses, certain procedures are under DRG, and other hospitals who like to do the more sophisticated thing that might not be covered. So the
Okay.
insurance companies will not be constrained in terms of its ability to grow as well. So I think for insurance companies, this has been one of the largest talking points for this year, and we think
Yep.
that as the risk comes off, the risk reward becomes better for these companies in the insurance side.
Since we are on the healthcare and insurance topic, right? Looking at your previous slide on Sunway Medical's potential valuation of closer to 18 20 time every EBITDA,
Mm,
and
mm, mm.
out of
Yeah, yeah.
curiosity, I visited Bangkok, right? The analyst blood is so curious. I actually paid a visit to Bumrad. Uh, it is not a hospital; it's a hotel. But looking at the valuation of Bumrungrad versus one of the top within the region versus Sunway, can you share with me? Is it on the potential premium is due to Sunway's ability to grow
Yeah,
further versus
yeah.
Bumrungrad's limited capacity, which is center of Bangkok?
Yeah, that's a interesting question. First of all, I think, well, again, these comments are probably my own view because I don't think we can comment on Sunway Healthcare Group, right? Officially.
Yeah,
I think how we like to think about the valuation is what is Bumrungrad trading at. We are talking about 13, mid-teens, 13, 14
yeah,
times EV/EBITDA. So the valuations currently that I think Sunway Healthcare Group in my channel checks is far higher than that, right? And one way we can check what the market is implied is what is quite simply we go and look at what the market is pricing in for Sunway Berhad, right? Then we can strip out all the other businesses, your property and everything. Then we can say, hey, once I strip out everything, I know that they are valuing their healthcare around 20 times, right? That is one simple but I guess ingenious way to not very ingenious way to do it lah. But
you just
it
reverse
does, yeah,
engineered
it
lah.
just reverse engineer, right? And to get about 20 times EV/EBITDA. So then we question ourselves, this 20 times EV/EBITDA, the most biggest question is, will Sunway give you the run rate to justify that sort of growth
Yeah,
multiple, right? We saw when IHH was listed previously, it was also at 20 over times. But of course, once the growth came off, it will eventually come down to now about 12, 13 times, 14 times. What we are saying is that in the initials, there's always a potential for the hospital assets to be valued at a slightly higher premium. But we think,
okay.
generally, to more specifically to your question, I think that the main reason that is possible is because currently Sunway Healthcare Group is there are three five hospitals and two are still sort of in gestation. So investors are willing to take a more optimistic view that the earnings growth will definitely come through and they give Sunway some premium lah. That would be the more optimistic thinking. Obviously, the play right here is where we have to be a bit more careful is because the guidance towards that growth trajectory is almost like guided to perfection lah. Meaning to say that
Okay.
if they don't execute right, then investors may start to question whether the valuation is worth it. Because even now investors are already questioning, right? So I
Yep.
think it would be a bet on the execution ability of Sunway Healthcare Management lah.
But I must say they are quite amazing because the
Yeah,
for
yeah, yeah.
Sunway Velocity, I think they did achieve operational break even within 1 year. So let's see. I think let's see.
Let's
It's
see.
yeah,
I think it's interesting. I'm sorry we can't give a view
yeah,
on this here, but of course what we are saying and what we can say is that IHH and KPJ the catch-up trade we prefer KPJ's valuation gap right now versus IHH. Yeah.
yeah. It's 9:15 now. Trying to call Isabel around. Isabel, are you around? And Madam Louis, yes. I think Peter has a year-end target of 1640, if I'm not mistaken.
Yeah,
Right, Peter?
yeah. That's right.
Yeah,
So again, I just emphasize that that is representative of only 30 stocks, right? So the other things that can make money are not even in the 30 stocks, lah, right? Your tag and
yeah.
your RE and all that. Yeah.
All right. I hope that we can manage to cover most of the question. We might miss some, but I hope the session from Peter is very insightful. I've definitely learned a lot, but we are running short of time, so sh shall not waste time. And let's invite Queen of Orange. Hello,
Okay.
Isabel.
Hey,
Thank
Adrian.
you, Peter.
Hey, thank you so much, Peter. Nice to see you again, Captain A. For those of you who have missed out, I hope that you've been managing to catch Adrian over there. He has been doing a bunch of our new initiatives, which is to cover IPO companies. And the videos are just fascinating. I know it's a bit tricky for you, Adrian, because you can't really delve into the financials so much, if I understand that correctly, right?
Here is an IPO. We shouldn't.
Yeah, but I think it's just really nice to watch you do these videos and kind of get a feel of these companies before they're even exposed to us. Because the
Yeah.
main thing about IPOs for many is that it's almost a branding exercise for some companies. A lot of them are privatized. You've never heard of them unless your uncle's cousin's brother works at them, right?
Yeah, that's
But
true.
yeah, so I think that is pretty cool. I'm really excited to see more of those videos. Can you see my screen and can you see my face?
Yes, disclaimer and your
Yeah.
face.
All right. So disclaimer, fascinating. You guys can have a look at it later. This is a bit more about me. I did as before I became the head of group equity marketing at Kenanga. I was a warrants issuer and market maker in the department next door, equity derivatives. But that means I specialize in structuring structured warrants and assortment of these kind of retail derivatives. But more importantly, and I think more relevant for a lot of our guests here today, is that I actually was trading these products before I became the issuer side. That means I was actually on your side. Granted, I was a IVT trader at a different bank, but the concept is that as somebody in my position, I know how it feels like to be very lost. And when everybody is talking about all these fancy products. Wait, hold on a sec. I want to use my highlighter. So for those of you here, you can see that these are the main things that we've done so far. We've won a lot of awards, but just like Adrian mentions in the beginning of the session, I am licensed just like he is. And the real thing about being licensed is that it's a very tricky situation compared to a lot of those people that you may see on Facebook, Instagram, or TikTok, where they are unlicensed. Now, the difference is when you are licensed, you're accountable for what you say. But for those people that you see, finfluencers, fin-top people, they are totally unaccountable. They can disappear tomorrow. For us, Adrian, myself, and Peter, we're not going anywhere. Right, Adrian? The awards that we've
Seems
won
so.
at the awards that we've won at Naga Warrants, the ones that we've won specifically for the structured warrants team, are the ones in red. For example, for global banking and finance, the best market maker, best warrants issuer. At Bursa this year, we won for the first time a double whammy, the best structured warrants issuer, equities warrants, and index warrants. Now you're wondering why am I so eager to share with you about these awards? It is because at the Naga Warrants department and our team, we hold ourselves to a higher international standard, and that can be seen through our Finance Asia. You can see at the side here. Finance Asia Awards and the SRP Asia Awards from Singapore and Hong Kong. Now, I'm just going to cover a bit of basics. I know that the past few months I've been focusing very much on differentiating the differences between Hang Seng warrants, Hang Seng CEI, and Hang Seng Tech. It was mainly educational. But I kind of want to bring back to the basics. Like Adrian said earlier, I was talking to him and I was saying, Adrian, I've covered everything there is to cover about structured warrants and I've covered it at least 5 times over. What on earth should I be covering at the moment? What I was thinking about was that we'll go back to basics and we'll talk about how you actually select warrants from the start. And for those of you who are just joining us here for the first time today, I know it's a bit late, but I won't take more than 9 more minutes of your time. Now it's 9:21 p.m. Do you mind just sharing with me who has actually watched these warrants talks? If it's your first time watching, just press 1 in the chat. Second time watching, press 2 in the chat. 3 times watching, press 3 in the chat. If you've watched it like 20 times over, then at least I know I can give you some extra juicy bits at the end. So just press 1, 2, 3, 4, 5 in the chat. If you've never seen my face before and this is the first time, just press 0, 0, 0. So what really works when it comes to structured warrants? And honestly, in trading and investing, there are 3 things you need to ask yourself. And the main things would be, so what? Why does this matter? Why does this news here? It's not showing my little arrow. Let me just draw this up for you. Why does it not actually demonstrate the success. How do I actually be successful as a warrants trader? So the main thing is success is determined by how much preparation you have. So the more prepared you are, the easier it is to spot opportunities and the luckier you get. So the luckier you get is a direct correlation with success. And if you tell me that luck doesn't matter, I'm telling you as a trader, luck matters. All right. But the more prepared you are over here, the luckier you get. Make sense? So what really matters? Say for the example of the news that happened over the weekend, the crypto crash with Trump's announcements, typically quite a surprise announcement to many people. Does it really affect you if, let's say, you are a trader in Malaysia and you're holding with a 1 year time horizon or a 2 year time horizon, or you're holding to give dividends to your grandkids? Does it really bother you? If it doesn't really affect you, wash it off, let it be, forget about it. The second question is, how do these people make money? Bankers, fund managers, agents, stock market gurus. As you guys should know by now, bankers, fund managers, they do get a commission or a front loading fee or back loading fee. So always keep in mind how these people make money from you before you actually buy the product. And for stock market gurus, a lot of them, especially the unlicensed ones, they are actually just trying to sell you courses, right? And trying to take advantage of using your lack of financial literacy and charging you for it. It doesn't mean there's some pretty decent ones out there, but I always say go for licensed ones. That's the easiest way. Now, when we look at the big idea, there is the barbell strategy. If I actually focus a bit more onto what it's all about, it is a lot of people talk about it. We have a talk coming out in the mid next month, and it's called the Invest Smart. It's happening at Mid Valley. And everybody's going to talk about barbell strategy. I'm telling you, it's a popular strategy because it works. But nobody actually tells you the calculation behind it or why it works. They just say, put a large investment into a low risk, higher reward item like this, and then put a small investment into a product that has a big payoff, for example, like Hang Seng Index warrants. But they don't tell you how exactly to calculate it. So for today, I'm going to break it down. Let's say if in year one, you've got perspective percentage of your portfolio. And let's say this is 100K. 100K portfolio, that means here is 30% of your portfolio is here, 50% of your portfolio is here, and 20% of your portfolio is here. That means 80% of your portfolio is weighted into fairly safe fixed deposit, and you buy ETFs. And when I talk about ETFs, another thing I want to cover is there are many kinds of ETFs. ETFs mimic the index, and indices are benchmark of a country, just like how maybe you gauge great restaurants, they are benchmarked by Michelin, for example, or maybe you're on a benchmark according to your favorite cousin who's a foodie. But it's always a benchmark. And the benchmark for a country's economic success is usually their index. Now, there are many different ETFs in the world. Every country has it. But the best performing one right now, and for the longest time, are the American ETFs, especially the S&P ETFs. So let's say I've got 8% average on the American ETF, ROI per year. And yeah, you can go and check it out. It is on average 3% for my FD. And how do I actually calculate an ROI? If I actually just use these two parts, I'm getting an average of maybe 6% ROI per year. Not very sexy, but if I trade Hang Seng, which offers something crazy like 50%, it boosts my whole portfolio to 14.9. Now, how do I calculate it? I take the percentage times the ROI, percentage times the ROI, the weighting of the portfolio, and that. And that's how I get the 14.9%. Now, to tie it with what happened over the weekend, which was the crypto crash, a lot of people, they would invest their whole portfolio, for example, into only cryptos, the whole 100% into crypto. And what happens is when you lose one, you lose all. The thing about structured warrants, and even for somebody like me who's a warrants issuer, I'm telling you 10%, 20% for example, is sufficient to boost your portfolio by a lovely number like 14.9 per year. So that's why consider a barbell strategy. A few things we're going to cover today. We've already covered the barbell strategy, but like I said, going back to basics, I want to teach you a bit more about MUSTI strategy in terms of the Hang Seng Index. So I've got 3 minutes. I can do it, Isabel. No problem. Step one for the MUSTI strategy when it comes to using it for Hang Seng indices, consider a FATA analysis or FATA strategy, step one. So step one, you choose the underlying. Step two, you choose the warrants using the MUSTI strategy. And step three, you trade the warrant using the last defense strategy. So let's say FATA analysis, fundamental analysis, let's see if the underlying intrinsic value is larger than the current price. How do I do this in a quick, easy way, Isabel? Because I don't have time. I'm thinking to myself, you've got a 9 to 5 job, you've got 2 kids, you've got a wife, or you've got a husband, and you've got so much to do. And Isabel, you want me to go and analyze the fundamentals of a company? And can you just give me a quick and dirty way to do it? Well, the quick and dirty way to do it is just check out a whole bunch of research houses' consensus reports. You can see that Peter, he does not go home. He just spends his entire lifetime and energy analyzing these companies. So there's no way to out analyze somebody like Peter. I just want to say, even for somebody like me, there is no way that I can out analyze an analyst like Peter. They put their blood, sweat, tears, and credibility, they sign the bottom of the research reports. Now, if a research report does called a buyer overweight, you can check the bottom of it. And usually it's something like 10% above in the upcoming year. That's their kind of gauge to issue an overweight. So you look at a whole bunch of those, and as long as it is the price, the current price is there, and say the research reports have a target price that is significantly higher, you can say that, all right, pretty fundamentally strong. But let's say a lot of people go, you know what? That doesn't really work because it is a fundamentally strong company, but it could move this year, 2025, December, or it could be 2026, March, or it could be, 2026, July. How do I know that I'm not just wasting my time waiting for the price to flatten out, even though the intrinsic value is higher than the current price? That's where technical analysis comes in, because it lets you see momentum into it. Kong, cute. Supermax used to be my darling stock. I had the best trading warrants during the rubber glove rally. So I do have a soft spot for Supermax. Technical analysis, entry price, target profit, stop loss. Those are the 3 things you need to analyze. So you can look into chart pattern analysis, candlestick reversal and continuation patterns. You can look into Fibonacci. You can look into Elliott waves. You can look into, what else is there? Gann theory. But the main thing about technical analysis is all you care about are 3 things: the entry price, target profit, and stop loss price. If it doesn't hit your entry price, you just wait for it. You don't put your capital in there and let it wait. You just wait for it to hit the entry price. When it says, all right, it has crossed a moving average, it has hit my entry price, then I enter. You don't enter before the signal. There's no point waiting and letting your capital sit there for 2 months, especially when it comes to structured warrants. Now, MUSTI strategy. When it comes to MUSTI strategy, I'm choosing 5 key things to remember. And it's a shortcut for me to remember myself and for traders such as yourself. Number 1, it must have, that was only one time, I hope I go. Number 1, there must be matrix. Number 2, there must be high effective gearing. Number 3, there must be tick sensitivity. Number 4, there must be sufficient time to expiry. And number 5, responsible issuer. Now, the first example I'm going to use today is more about Hang Seng, and I've never actually covered this topic before. So let's say you can read this later in your own time. The issuer should offer a pricing table over here. The reason is because warrants have dynamic pricing. So if I screenshot the table today, it will be different tomorrow. So that's why you need to keep on referring to the nagawarrants.com website. It helps you time your 1, 2, 3, which are these 3 things here, using the last defense strategy. And of course, all Kenanga warrants come with a Naga matrix. Now, the tricky part is this. How do you choose a girlfriend, I always say, that has high effective gearing? That means maybe very attractive, all right? But she's also very sensitive, tick sensitive to your needs. Because when it comes to a warrant that has very high effective gearing, this girlfriend that you are pursuing, this girl, she's super attractive. But she's not very sensitive to your needs. She doesn't really care about you very much because she has too many options. So the thing is, you need to kind of balance something with high effective gearing and reasonable tick sensitivity. Finally, time to expiry. If you're a long-term trader, you avoid warrants with less than 1 month to expiry. The question to ask yourself is, if your warrant has 2 months remaining, can it really hit the target price number 3 within a month, for example? And number five, responsible issuer, fair pricing, responsible on Telegram. And the next time I see you next month, I'm going to cover a bit more about step 3, the last in, first out, last defense strategy. But a case study before I leave you today. So let's say I'm looking at all the warrants available by Kenanga warrants, Naga warrants. And if you look right at the bottom of my screen here, can anybody tell me what that says? How many warrants does Kenanga have on Hang Seng? Not even Hang Seng CI, not even Hang Seng Tech. The Naga warrants team, they've issued 48 Hang Seng index warrants. Yeah, Adrian, 48. How do you choose? So that's where you go back to the strategy I mentioned earlier. You use the Musty strategy. And a lot of people, after I've trained them over the years, because I've covered this strategy many times, you can see that over there they choose the highest traded warrants in the market right now. Today it traded 132 mil, 82 million traded, 50 million traded, and over the last few weeks we almost touched a billion earlier this week. But the main thing to remember is that people tend to look for warrants that have high effective gearing. That's the E over here. EST, time to expiry, and issuer. There you go, MESTI. Now, the difference between a warrant like Hang Seng CWI2 and the CWI1 is that you can see the ticks, 40 ticks and 90 ticks. So what this really means is that it has more CWI2 is less sensitive to your needs, but for people that actually want that, they don't want a girlfriend who is overly sensitive and overly jumpy. If I see Hang Seng move 90 points, futures points, then I know this CWI2 will move 1 tick. For example, if I'm extra aggressive and I'm an intraday trader, then I'm looking at CWI1 that has 40 ticks. She's very sensitive, she's very clingy, and if that's your preference, so be it. And that wraps up my session for today, Adrian. 9:35. I'm sorry it took a few more minutes of your time, but I hope that was educational for all of you.
I think just nice. And why so? Because we have very enthusiastic participants tonight, especially Madam Louis. Thank you for also reminding us how the structured financial product have improved. And we are not supposed to be comfortable because it is when we are lazy, we tend to take things for granted. So we must always keep ourselves on the toe, and especially in managing risk. And yeah, again, I'd like to take this opportunity to thank Peter for his insights and what the team has done, the whole research team has provided in terms of the value of a lot of things that even myself couldn't cover, and we need a team. Yeah, that's why. Thanks, Peter and the team, and also Isabel for highlighting why a barbell strategy works, like how I see it in Peter's overweight barbell kind of representation also. And yeah, I'm looking forward for the last part 3 also, Isabel, for the musty strategy. Yep.
Oh, yeah.
So let's call it a night. Good night, guys. Thanks again. Thanks, Peter. Thanks, Isabel. And
Thanks,
thanks,
Captain
Madam
A.
Louis.
Thank you. Thank you,
Bye,
everyone.
guys. I'll see you guys
Good
on the
night.
next webinar. Bye.
See you, Kong.
Signing off. Landing soon. Bye.